$104,100, right? So in excess, we are receiving 4,100. So that's the premium, right? So we decided when we issued the bond at discount, the discount was our expense. So this is our retainer, not retainer, because this doesn't belong to honest equity. This is our credit that we receive. This is like a reserve. We receive more, and we will use that reserve to decrease our interest expense. So it means the carrying value will decrease to the bond value. So in discount, the point here is that in discount, when we issued the bond at 96,000, we add at maturity. At maturity value, we add the discount. So the carrying value of the bond will increase and ultimately will go at the end of the period till its face value, right? But in case of premium, it is the opposite. We less 4,100 at the end of maturity. The value of the bond must be equal to its carrying value at the maturity, or maturity value, or face value, right? So what is the entry? So this is basically a negative sign. So remember, this would be treated as a reserve. So increase, this is opposite to discount. You can say that. So discount increase, we said that it's debit. But here, premium increase, it would be credit. So entry would be that we issued the bond, we received the cash. Cash received exactly equal to 104,100. Here we go. Right? And what is our liability? Our liability is to pay after 5 years 100,000, right? But we are receiving 1041. So this 4,100 extra is our premium. Now entry is complete. Any question regarding this entry? Pinyo, understand?
No question.
Now,
yeah, Crystal.
Marilyn, understand?
Yes.
Good. So if we want to make, okay, we'll talk about the amortization next slide. So how this works? So remember our accounting equation. This is just for your knowledge. No, this is not the requirement, just for knowledge. Remember, our entry is balanced. Why? Because asset increase, debit 104,100, and liability increase, credit, and premium increase also credit. So our accounting equation is balanced. Our entry is balanced. So how we are going to show this on balance sheet? So remember, our bond payable is 100,000, and our we here plus sign. In case of discount, we here have a negative sign. So remember, our maturity value, our the liability that we have to pay after 5 years, 100,000. If it's a discount, here is a minus. If there is a premium, we have a plus here. So carrying value is now above the maturity value, above the face value of the bond. So it needs to decrease at the end of 2019. So amortization table would be, so we have a data here that the issue date is 1st January 2014, maturity date is 5 years, so you add 5 years, 2019. Face value or maturity value is 100,000. Stated interest rate, which is coupon rate, already given 9%, and the payment is semi-annually. which means 4.5% we have to pay after every 6 months. Yeah, and the market interest rate is 8% and payment is semi-annually, so 4% is semi-annually. So all you need to do, you need to calculate your interest payment and interest expense. Interest payment is related to your coupon. How much you actually pay, how much is the cash outflow. Actually, cash outflow is that what is your promise? Your promise that you will pay the coupon. Coupon is 4.5% of the 100,000. So 4.5% or 9 into 6 by 12, answer would be 4,500, right? Interest expense is based on market interest rate, right? So market price into market interest rate. Market price is that we issued the bond at 104,100 and 4%. So answer would be here. So did you see a huge gap here? In bond payable, when it is issued at discount, our interest expense was greater than interest payment. But here, our interest payment is greater than interest expense. So you can say, yeah, interest expense is less than the interest payment. So it's the opposite one, right? So what is the entry now, or the amortization here? So the same procedure, right? Just in this case, premium would be less from carrying value. In case of discount, we add the discount. We add discount on our carrying value. But here we have to match our market value right now at the moment to the face value. So market value right now is above, so we need to decrease that. So where this 4,500 is coming from, so our original value is 100,000. 100,000 multiplied by 4.5, answer would be 4,500, or 9 multiplied by 6 by 12, answer would be 4,500. So where this interest expense is coming from, it is market price multiplied by market rate. Market rate is 4%, and 4% multiplied by 104,100, right? So here we go. So if we minus this interest payment minus interest expense, the difference is 336. So 336 will be decrease from our premium. Here we go, right? The premium would be decreased, and this premium would be less from the carrying value, right? So our carrying value decrease and our also premium decrease, right? So it means part of 4,100, 336 would be decreased from our carrying value. So next is going to be, we know that payment is based on fixed 4.5%, so payment won't change. But where this 4151 is coming from, 4% multiplied by the carrying value 103764. If you multiply that, answer would be 4151. So the difference is 346. So 346 would be less from the premium and less from the carrying value, right? And at the end, the last one is a plug figure here. So you see here, if you multiply 4% with the 100,544, answer would be different. But remember, this is the last payment and premium must be 0. So this 554 is coming from just a plug figure here. So here answer would be 100,000. So difference is 544. So you add 544 here. So what we less from 4,500, answer would be 3,956. So the last number, like in our discount, it would be a plug figure, right? There we go. So you understand the amortization table here? Ella?
Yes.
Nam?
Yes.
Marilyn? Pinyo?
Yes.
Okay, let's move forward. So this is all the procedures that it says how we calculate the next. So it would be again 4,500, right? Where this is coming from? It is coming from market price multiplied by 4%. Answer would be right. This is amortized premium. Amortized premium mean premium is going to be decreased to 336, and that would be also where it is coming from, the difference between interest payment and interest expense, and that would be delete from our premium, and we also delete from our carrying value, or less from our carrying value, right? So at the end, so this 104,100 at the issuance must be equal to 100,000 at the maturity. So it would be always 100,000 in case of discount and in case of premium, right? Now let's make the entry. So the first entry, so remember the payment dates are the next year start of the date. So here we will create liability, which is payable, but this is in the period 2014. So this is a cash payment. So remember, payment always belong to coupon. So how much we pay? Pay means cash decrease, asset decrease mean credit. So payment is going to be decreased by 4,500. Interest expense is 4,164. And remember, our premium is decreased. When premium increase, we said credit. When premium decrease, it would be debit. So entry would be interest expense 4,164, premium 336 to cash. That is the entry, right? So at the end, this entry is balanced, right? So the difference between the interest payment and interest expense is that in case of premium, interest payments are always greater than interest expense, which is opposite to discount on bonds payable. And at the end, the carrying value must be equal to 100,000. So we decrease this premium to 0 until this become 100,000. Simple. So this is our borderline for bonds maturity value, right? So all this premium would be amortized and less from the carrying value. That they just want to show through graph, right? Now, rather going through amortization table and all those stuff, why not we just apply the straight line method? If it is 4,500, for 5 years, we divide it by 5. That's here. And then we decrease on normal basis. We can also do that. If 4,000, if 5,000 discount for 5 years, we divided it, and we are going to charge discount 1,000 every year. We can do that, right? So both methods are acceptable, but if you are using straight line method, you need to mention, you need to more expressive that okay, you are using straight line method for amortization, rather going to the the interest payment and interest expense, how we calculate the expense amortization table. You need to add the